Let's start off. I mean, we just heard there that the economic outlook will soften. I mean, at some point, these rate hikes are going to bite. You're avoiding cyclicals.
Yeah, we just see too much complacency. You can see that in the VIX back to pre-COVID levels, but when I look across the credit spectrum, there's just not enough cyclical risk premium priced in.
Yeah.
We know the uncertainty's there, but for the moment, investors are closing their eyes and not paying attention to it. And hoping.
Do you think that that's going to last? I mean, we had a guest from SocGen yesterday saying as soon as we start feeling the effects of monetary tightening, credit spreads in the U.S. could widen as much as, I think it was 80 basis points?
Yeah.
Do you see that sort of materializing in any way in the next few months?
It's definitely a risk case, and we know that policy works with a lag, and it takes time to see the full force of it taking effect. And the claims data in the US yesterday is beginning to see that effect taking hold. We need a softer jobs market to get inflation coming back down.
Tell me something here, Adam. OK, we've got this $1 trillion worth of T-bills going into the market. Who's going to buy them? That's one part of the question. I mean, there's a lot of pushback from the Chinese, apparently, behind the scenes taking place, because they normally buy them, and if they don't, well, even more liquidity is going to be sucked out of the system. How does it affect, then, credit spreads? And then how does that feed into that whole banking situation we had earlier this year? Because the fear is that we could get it coming back.
Yeah. And, $1 trillion of T-bills, you either need to sell something to buy the T-bills or you turn your cash into T-bills itself. And the issue could be that whilst money market funds got a lot of dry powder, do deposits move into T-bills, and therefore there's that further pressure on the banking system. Our base case is that the issues that you've particularly seen in the US regional space are not systemic. But certainly if you look back in time, when you move from a orderly to a disorderly market, it tends to be when you get that funding tightness, and the T-bill issuance could contribute to that.
Right. What does that tell you about, I'm not sure how much you covered this, AT1 bonds, for example, given, of course, just the underlying story of the mispricing that took place, that collapse in AT1 bonds, for example. Is that something that you cover?
Yeah, so AT1s for us...
And how do you feel about it?
Sure.
Yeah.
I mean, you're selling an option. You're selling an option that the bank redeems it, and you're selling an option to regulators. And we've seen that option can be very expensive.
Yeah.
So we're not a huge fan of the asset class, but we certainly see a lot of opportunity further up the capital structure within banks. And from crisis comes opportunity, and we can use our security selection to pick the winners and try and avoid the losers.
So senior debt, for example,
exactly.
and bank.
Yeah.
Okay. And within senior debt, for example, is it Europe? Is it the US?
A bit of everywhere. So at the moment, I think the most protective strategy you can have is to diversify. So not putting all your eggs in one basket, whether it's by region or by sector.